Hey everybody, hope everyone's doing well and had a good day today. In this video, I will review the Emini 5-minute chart for Tuesday, June 24th, 2025, and I will add a marked up PowerPoint slide of today's chart at the end of the video. Going into the day, we had a fairly big gap up. And really quickly, let's talk about the daily chart so we can get the higher time frame context involved. Here's the information we had leading into the day, and the market is in a bull trend. It's a bull channel, so a tight bull channel. We have a couple of legs sideways to down, maybe 2 or 3 legs, depending on how you count it. Maybe 1, 2, 3, 1, 2, 3. But either way, to me, looks like a high 3 at the moving average with a strong signal bar in a bull trend. So I think as far as selling above yesterday's high, I think it's risky. I think traders might sell at a distance above yesterday's high, like maybe at the prior trend's extreme. But I think the risk is real that we go for a measured move up in this context. So again, fairly strong bull trend, and then a wedge bull flag with a strong signal bar closing on its high. Would not be surprised if there's follow through buying going into the day, but then of course we had a gap up, and because of that, let's check out the Globex chart really quickly. I like to look at the 15-minute chart. Here's the information going into the day. So yesterday's close was over here. The market continued to channel, tight trading range, bull breakout, and then another tight trading range up here. Most of the bars spent above the moving average. This tight trading range might make breakout probability 50-50, but for a major trend reversal, in other words, for this bull trend to reverse into a bear trend, usually what you need to see is a strong trend line break and then a retest of the old trend's extreme, the bull trend's high, and then maybe the major reversal down. But here, this looks more like a minor reversal. It's a trading range, lots of overlapping bars, and even if you draw the channel like this, connecting these lows over here, it's not even that much of a significant trend line break. The trend is weakening for sure, but if we think about both perspectives, the bulls might see, just like on the daily chart, bull breakout, 1, 2, 3, wedge bull flag. And the bears are hoping that maybe here's a bull trend line break, 2-legged retest, major reversal. But is this a strong bear trend, or does it look like a leg in a trading range? Lots of dojis, bear bar, bad follow through, bear bar, bad follow through. Where are the consecutive big bear trend bars? So again, it looks like a minor reversal, and if that's the case, the expectation is that this is a leg in a trading range, and we will retest the highs, and if the bull trend is still in effect, maybe even go for a measured move up based on the height of this trading range or flag. So that's what we had on the 15-minute chart, on the Globex chart going into the day. Now for the 5-minute, we see the gap up, and you can think about the gap as simply a breakout. If that's the case, big bull breakout, surprise, you could call it a surprise. It's a large breakout. It's probably going to have a reaction, and then bar 1, follow through buying. It's minimum follow through. It's a doji bar, but it's closing above the open and closing above the midpoint. So probably we'll get follow through buying in a second leg up. When there's a big gap like this going into the day, the odds are there's going to be a tradable second leg within the first hour or so. So we're going to look for a second leg up here. Bar 1 being a trading range bar, not ideal for buying above. There's probably sellers above, but buyers below. It's a bad sell signal. Bull trend bar on 2, sellers above 1, maybe trapped on 2, scaling in higher. Bars 1 and 2 will probably get a second leg up, especially with the gap up. And then bar 3, weak bull bar, so closing below its midpoint, it's a sell reversal bar, but a bull body, so not a very strong signal bar. 3-bar micro channel on the open, probably buyers below, second leg up, likely. Now, bar 1 is currently low of the day, and bar 1 remains the high or the low of the day, only about 20% of the time in general. Now, this might be a bull trend from the open. We have a gap up, we have 3 consecutive bull bars, but we have to be ready for a test below bar 1. Again, in general, 80% of the time you're going to have a trading range open, not a trend from the open. And if we think about bars 1 through 3, we have a trading range bar 1, trend bar 2, trading range bar 3. So not as strong as it could be, might be a leg in a trading range. And if that's the case, we might test all the way back down below bar 1. Again, if you just scroll back and look at most days, even days that end up trending, sometimes the market will go test, if it's a bull trend day, it'll test below bar 1 and then enter a trend. Usually we get a trading range on the open, but 3 not a particularly strong sell setup. Bar 4, now we have an outside down bar. It's a micro double top, trading range on 1, bull breakout, trading range on 3, up, down, better for the bears. For the bulls, maybe they'll wait to look to buy lower. For a micro channel like this, what bulls will do typically is buy below the last strong bull bar. Bar 3 closed below its midpoint. That's a weak bar. Bar 2 is the last strong bull bar. So first, limit order buy is probably below bar 2. But because there's a micro double top and we have not tested below bar 1 yet, traders may cancel that limit order, or they might be quick to exit and look to buy lower. There might be a stop order, sell below 4. If you're long, reasonable to exit longs below 4 and look to buy lower. Reversal and follow through on 5. Strong enough for the bears to get a second leg down. And not a good stop order buy for the bulls on 5. Probably need to go lower or get maybe a double bottom with 1 before the bulls come back in. And the bigger bar 6. So small bear body, bigger body, and then even bigger body. Momentum is growing. The bars are growing. Now we have a 3-bar micro channel, 4 through 6. Probably sellers above 6. Second leg down likely. Just like over here, bears will sell above the last strong bear bar. So that's bar 6. So there's a limit order sell above bar 6 for a second leg down. 7, not quite an inside bar, but lots of overlap. It's a failed bear breakout below bar 1. Now the problem down here, we're testing below bar 1. And after a 3-bar micro channel and probably a trading range open after a gap up, there's probably buyers below 1. And we find buyers below 1, but now 7 is after 3 consecutive bear bars. Now we have a 4-bar micro channel. So probably a minor reversal here, sellers above 7, second leg down likely. But double bottom for the bulls, there's an argument to buy above 7. 8, bear breakout, but failed. Bar 8 is a variation of a wedge. When you have a failed breakout of a double bottom, so lower low double bottom, 1 and 7. So we have 3 pushes down, 1, to 3 on bar 8. This is a variation of a wedge. Functionally, it's the same as a wedge. So even though the shape isn't great like a traditional wedge or 3-push pattern, functionally this should behave the same way. Gap up, wedge bull flag. Also the gap up and 1 through 3 still needs a second piece. So because of that, the gap up and the rally to the high of the day needs a second piece. This is a wedge, which should correct for a couple of legs sideways to up. So because of that, we're probably more in a buy zone near support in this moment, but really not a great stop order buy above bar 8. Inside bar 9, but like I said, probably more of a buy zone. There's a couple of reasons to expect higher prices here. Inside bars, usually traders will fade inside bars. They are trading range bars, range compression, lower high, higher low. Breakouts of inside bars usually pull back and test the breakout point fairly quickly. Bar 10, breakout bar, good for the bulls. But again, breaking out of an inside bar, so we may have to retest the high of bar 9, but good looking bar in the context is good. Wedge after a gap up and a strong breakout bar. So okay to buy bar 10, buy above bar 10. Follow through 11, what's the problem here? We're testing an area where traders got trapped earlier. If you bought below bar 3, the market is testing that price again, so probably at least temporary resistance here. Trap traders here, scale in, they look to exit at break even. Plus, we might retest the high of bar 9. So we find some resistance near the low of bar 3. Now we have a 4-bar micro channel, a pullback testing the breakout point of the inside bar, bar 9, and probably a minor reversal. Again, after the gap up and the rally to 3, and the wedge 1, 7, and 8, where we should get a couple of legs sideways to up. Still, a couple of reasons to look to be long here. Set the low of bar 8 to bar 11 might be leg 1. Minor reversal, we may get another leg up. But bar 12, a bad stop order signal bar, forcing you to buy high in the range. 13, bull bar closing on its high. Lots of overlap with prior bar. But might be a tight bull channel from bar 8 to bar 13, and there's no stop order sell. If there's a bear bar closing below its midpoint, reasonable to exit below it. What about selling below 14? Small inside bar, probably buyers below and a minor reversal. The bears are hoping it's a nested low 2, so low 1 below 4, low 2 below 14, and then low 1 below 11, low 2 below 14. Double top with 4 and 13, and micro double top, up, down, up, down. But again, tight channel, bullish regime on the higher time frame, and we can see on the 5-minute the gap up, all the bars above the moving average. And the bears have a completed structure here. Down on 6, pull back, down on 8. So that's 2 legs down. So in general, as far as selling here, probably better to wait for a decent bear breakout and look to maybe enter on a breakout pullback to capture a second piece down. Probably buyers below 14. Now 15, a third push testing the highs, 1, 2, 3, but tight channel. It might be a parabolic wedge, it looks like it is. If we connect the highs of bar 11 and 13, 15 is breaking out of a channel line, but the expectation for a parabolic wedge in this context is a minor reversal and then trend resumption. So the market might test the low of 15, but even if it does, that reversal is probably minor. It's a tight channel. This is a breakout on a higher time frame. So we may pull back, but ultimately get to a new high. Pause on 16. Bears, they see a wedge double top, 1, 2, 3 pushes up, double top with 4, but tight channel, the approach is too strong, not enough selling pressure. This is a 0-point gap, so it looks like 5 bar 9, 61.19, the low of 12, 61.19, so they're at the same price. This gap did not close. The market did not close below this high. And there's certainly a body gap or a negative gap. If we look at the line chart that plots closes, the close of bar 9 and the close of bar 12 do not overlap. So tight channel up to 16 might be a double top. So the bears, if we think about the trader's equation, it's always a low probability trade with good risk reward and a high probability trade with average or not so good risk reward. So on 16, if you're selling 16 as a wedge double top, the bar is small, your risk is really small, and you might get 2 or 3 times your risk, your initial risk, back on the trade if it works out and we test the lows and we get maybe we get the double top, the bear breakout, the reversal down. And that's great. You have good risk reward, but the trader's equation is made up of 3 variables, and those are risk, reward, and probability. And probability is the one that I think traders neglect the most or don't understand the most. It's the hardest one to get a grasp on. For me anyway, it was the hardest one because I think that's natural. You have the ability to choose your entry, you choose your entry price, you choose where your stop loss goes, where your initial risk is, but probability is never certain, and probability is developed through market studies, so research on market behavior, and honestly just experience too. So with that said, if you're selling below 16, you need to understand that you're taking a low probability trade. You're taking the lower probability side of things. And what's the flip side of the low probability sell on 16? It's to buy 16, buy the close or buy below 16, and look for at least a retest of the highs, a new high of the day. 17 drops below 16, traps stop order traders below. And if you sold, you probably exit above 17. If you sold and you have a stop above 16, you have to be thinking at that point, your stop is probably going to get run above 16. No reason to just sit there on your hands and let your stop get run above 16. So we may break out above 17. And then 18, a little bit of a surprise, rallied above 17, tested near the high of 16, but then reversed back down. 18, strong enough bar for a second leg down. Outside down, broke far below the low of the prior bar, which should get a reaction. There's probably resistance near the low of bar 17 now, so 18 may get a second leg. But in the big picture, this is still probably a minor reversal. 18 is a bad stop order buy. The bar is big. It's a bear bar, and you're at the top of the range. So probably sellers above 18, but probably buyers below. 19 rallies to a new high. Now at this point, the trend may be getting weaker. As we test a new high, bulls will start to take profits at new highs and bears may start to sell. But this is still a tight channel. And until there's a strong bear breakout, there's really no reason to sell. Bears just had 2 legs down on 18. And it seems like the bulls are in control. It's always in long, tight bull channel. 19's a bad stop order sell, probably buyers below. What about bar 20? Can you sell below 20? 20 is a reasonable stop order sell. Big low 2, 4, and 20. Micro double top. up, down, and even here, up, down, down. Bulls probably exit below bar 20, and bears can sell, but you're still trading against a tight bull channel. So this is still the lower probability side of things. If you're selling below 20, maybe hope to get twice your initial risk, but the reality is you're going to lose that trade most of the time, and the market's going to rally to a new high. And in 21, we did not even trigger the sell below 20. Inside bar, 21, like I said on 9. Either way we break out, we'll probably retest the breakout point within a couple of bars, but probably buyers below 21. As far as selling above 21, there might be sellers. Maybe it's 1, 2, 3 pushes up, but in the environment, tight bull channel, anyone selling is selling for a scalp. It's easier to make money trading in the long direction. Breakout above 21, but 3 pushes up to 23. 6 bar micro channel to 23 probably will get a second leg. This might be a big second leg, so leg 1, pull back. Leg 2, we may need a third leg up. And then 24, inside bull bar, closing on its high. Really no reason to sell. This is a scenario where if you're long for any reason, doesn't matter where you bought, you probably just exit below a bear bar. But where's the bear bar to exit below? So the bulls are in control. The only options here are to be long or to be flat. What about 29? 29 might get a second leg, but it's probably a minor reversal. And now this looks like a big second leg up and more symmetrical. So here's leg 1, maybe leg 2. So there's still room to the upside for a measured move. Plus we might get a measured move up of the opening range. This might be a bull trend day or a bull trading range day, but unlikely to be any kind of bear trend day or bear trading range day. Again, 29 probably a minor reversal. For a major reversal, you need a trendline break and a retest of the highs, and 29 bear trend bar, but overlapping the prior bars and following a very tight bull channel. 29 tail below, so buyers into the close, and then a second leg down on 30. This is very minor, but 30 is 2 legs down on a smaller time frame, testing support at the low of 25. So this is and if you include the low of 28, this is very minor, but this is basically a wedge, double bottom, in a bull trend. So 20 or 30, bar 30 might be a buy the close bar. We test the support once again, and we start to reverse back up. Now 30 is a bad stop order buy. It's a high one, but consecutive bear bars, there might be sellers above for a second leg down. But again, it's a minor reversal, and the risk for the bears is we get a measured move up based on the height of the minor reversal. Pausing, bad stop order buy 30, triggered on 31, but bad follow through 32, but still a minor reversal. Selling below 32, low probability, but good risk reward. So higher probability trade is to buy below 32 and look for trend resumption. We do not trigger it, just like down here. 3 bar micro channel to 33, probably buyers below, second leg up, likely. Where's the bear bar to exit below? Even if a bull exited below bar 29, they could have bought again above bar 31. And, big picture, it looks like we have 3, or we're getting a third leg up. 1, pull back, 2, pull back, 3. We can draw a channel line. One thing that I didn't pay close enough attention to years ago is how I drew my channel lines. And it's really important to be precise with your drawings, even though support and resistance aren't perfect. So if this leg began on bar 8 and ended on bar 16, there's the start of the channel line. We pulled back, second leg up to 28, and then it looks like we're testing this channel line. You may draw it a little higher because of bar 26, but the important thing is to, include leg 1, pull back, leg 2. I just like to include a line that is getting the most tests. So I like overshoots more than undershoots. So because 26 overshot this channel line, I like drawing it that way more than this, because 27, 28 are undershoots. So that's how I draw the channel line. 37 approaching the channel line in leg 3, 1, 2, 3. If you're long, you might be quick to get out, knowing that you're in a late leg near the channel line. Now, bulls might be looking to maximize profits here. This doesn't mean because there's 3 legs up, you expect a major reversal and a test all the way down to the start of the channel down here. For a tight channel or a parabolic wedge, I'll get there in a moment. Let's continue. 37, 38. So we have a small bull bar, bigger bull bar, and then an even bigger bull bar, 39. Now this is a nested parabolic wedge. The bars are getting bigger here, and the market is kind of going up unsustainably like this, like a hockey stick, and it's the same here. Here's the channel line, and we're breaking far above it on 39, but 1, 2, 3 legs up. 39, the biggest bull bar in the rally, at least in the third leg. Maybe 23 is bigger, but it's one of the biggest bars, and it's late in the move. We are just about 30 bars into the trend. So after about 20 or 30 bars, you start to get the biggest or strongest looking bars in the trend. You got to be thinking this might be exhaustion. So this is a common bull trap. 39, better for profit maximizing. 39, a sell the close bar if you're long. It's aggressive to sell, to go short, but there are reasons to. That's just, some traders will trade that way. Sell the close, 39, stop a measure, move up. What's the expectation here? For a parabolic wedge, the expectation is a minor reversal and then trend resumption, especially here. This is small pullback trend behavior. Pullbacks lasting 1 to 3 bars, not very deep. Looks like I'm in a trading range all day, but continually grinding higher. So expectation here, minor reversal and then trend resumption. Sometimes the market goes back and tests the start of the third leg, which is what I have drawn here on 31. But this rally was so strong, I wonder if we only get to maybe the midpoint of it. So 39, breakout of the channel line, late in a trend, expect exhaustion and at least a minor reversal. 40, there's the bear bar that if you're long anywhere for any reason, including on the close of 39, if you bought the close 39, you exit below 40. That's a default exit. 3 legs up, parabolic, far above the moving average. Expectation, couple of legs sideways to down. So 40 needs a second leg down, better to just get out and look to buy lower. Reversal and follow through, bad high 1 above, sellers above. 3 bar micro channel, sellers above, second leg down likely, bouncing at the 50% pullback. Bad high 1, 3 bars down, probably sellers. Bulls who bought 39, trapped 40 to 42, might use any bounce here they can get to exit. And if we zoom in like this, I don't want the chart to get too busy, but it's worth showing. If a trader bought the close 39, bought more above 42, the market is retesting that average price, the true break even on the trade. Couple of legs sideways to up, but 42, or I should say 40 to 42, still needs a second leg down. Now, this is a good example of the fractal nature of price action, how everything is breakouts and second legs. Bear breakout needs a second leg down, 42, 43. Reversal and follow through needs a second leg up. Breakout, pullback, second leg, and even in here, it's very minor, but 45, rallied, pulled back, got a second leg. On a smaller time frame, it's more clear. 46 is actually a wedge bear flag. It's kind of crazy to see it that way or call it that, but if you go to a 1 minute chart, that's what it is. 40 to 42, a bear breakout. Minor reversal up to 43, but enough of a trendline break for a reaction. Buyers below the low 1, second leg up, and you can call it 1, 2, 3 pushes up. Bears still need a second leg down. The bulls have completed structure. So 46, probably a sell to close bar. Bear breakout 47, but testing support. We have the 42 low. We have the midpoint of the rally from 31 to 39. So 47, I said sell to close 46, but 47 might be a buy the close bar. This might be a second leg trap. 1, pullback 2, against a very strong bull trend. Also the first test of the moving average all day. Traders have been buying above the moving average all day. Odds are, first test of it, they'll buy it, especially when the approach is a couple of legs down. And not, something strong like consecutive bars for the bears. So probably buyers here. 48, a bad follow through bar. Big breakout bar, but smaller bar. 48, bad follow through. Still probably by the close. Not a good stop order buy above 48, or I should say a good stop order signal, but the context makes sense. Better to buy than sell, or I should word that differently. Probability favors the bull breakout. Broke out above 48, but big tail on 49. But 49 might be a buy the close bar. On a smaller time frame, 46 through 48 is a bear trend. 49 is a trend line break and a retest within the same bar to breakout pullback. So you could buy the buy zone of bar 49, you could buy the close 49, you could buy below 49, but probably buyers here. We tested a little lower in the bar in the buy zone and found buyers. Now we have a 3-bar micro channel, 48 to 50. Bad low 1, probably buyers below. 1, 2. If you're selling below 50, you're taking a low probability trade. You're trading leg 3 against a strong bull trend at support, 50% pullback of the last strong rally. Now this is all expected behavior. Remember, after this parabolic third leg, the expectation was a minor reversal, a couple of legs sideways to down, which we got, and this might be trend resumption. So dangerous to be selling here. 51 a give up bar. Probably buy the close 51 and probably get a retest of the 39 close and a new high of the day. Buy the close 52, but we're testing this price where traders got trapped on 39. If you bought the close 39, had a stop at the major higher low swing point, 31, and you didn't panic, you could have scaled in. We're retesting this price where the original buy, 39, was obviously not ideal, but a trader who buys here, buys more at the 50% pullback or somewhere, they're getting a chance to exit at their original entry price on 39. We can see a small reaction on the tail on 52. The approach is too strong. It's not like there's a great reason to sell here. to go short, but I do think it's reasonable to take profits on longs in this area, 39 close or new high of the day. 53, bull breakout closing on its high, but look at the tails, 51, 52. 51's a breakout, pullback, and there's really a two-legged pullback here. The high of 51 down to the low of 52, breakout, high of 52, low of 53. So these are two-legged pullbacks. One, pullback, two, pullback, three. So it's very tight, but this is three pushes up to 53. 53 might be a sell to close bar. Again, more for profit taking for bulls than to sell. Do you really want to sell a 5 or 6 bar bull micro channel? Probably not. It'll probably have a minor reversal, in other words, pull back, but ultimately this will likely get a second leg. And who knows? This is a strong trend, so this minor reversal, all of this, 39 to 48, may get a measured move up. $54, low probability sell, probably buyers below. Bears see a higher high double top. The trend line break wasn't all that strong, and it looks like the bull trend is still in effect. Draw a parallel. Maybe it's something like that. There is resistance above, and there's room for a second leg up. And really not a great reason to sell below 54. Not a great reason to sell. 55, okay to hold long. We trigger the sell below 55, reverse up. Now we have a high 2, high 1, 54, high 2, 56. Bulls unable to get consecutive closes at a new high. So maybe it's converting into a trading range. But again, still stronger for the bulls than the bears. The trend line break wasn't very strong. We have maybe one close below the moving average all day. So we might get more of a minor reversal here. 56 might be better to sell above, but for a scalp, because this bull micro channel still needs a second leg. So maybe we'll test a little lower, maybe the midpoint, and then get a second leg up. So sellers above the high 2, reversal down, but 57 might be profit taking for the bears. You sell above 56. And let's think about a little earlier. Let's say a trader sees breakout follow through 48 and they sell. Obviously not a great sell for the reasons I talked about earlier. But if we think about trade management and you sell there and you sell more below a bear bar, 54, 57, you're really not even getting there. It's not a great example, I guess, but even if you took a really bad trade and scaled in higher, market usually comes back and lets you out at break even. In this case, and here's another problem for the bears. If you're going to sell over here, probably better to sell above 47. 3-bar micro channel, sell above the last strong bear bar, maybe above 48, but again, for the reasons I said, better to buy down here. 47 might be a sell above. Traders who sold above 47 got trapped and on the bull breakout to a new high. And now the market's testing this price again on 57, so there might be support here and the downside might be limited. 57 might need a second leg down. The problem, it might already be 2 or 3 legs down. 54, 56, 57. 57 itself will probably get a small second leg. But after this rally in the big picture context, while 57 might get a second leg down, it might be better or more worth looking to buy that second leg rather than capturing that second leg. So in other words, rather than trying to sell the midpoint of 57 for a scalp, look to buy maybe below 57 or 58 or the midpoint of this rally, because the rally is stronger than the sell-off 57. 57 is an outside bar overlapping the prior bar. It's just one bar with no follow-through. This is sustained buying in the direction of the big picture trend. Tight trading range, couple of legs down, one pullback, two. Now again, it might be one or one pullback, two, pullback, three. This might be a wedge, bull flag testing support, wedge double bottom. Again, the 47 high. So this area, probably dangerous to be selling. Better to look to buy. Not a great stop order signal bar, but context is good to buy. So if I had to choose on 61, probably would rather buy above 61 than sell below. Certainly would rather buy above it than sell below it because it's three legs down testing support in a bull trend. And leg three fails more often. And this is setting up a wedge at double bottom in the direction of the trend for the bulls. So better to look to buy here based on my beliefs, my experience. 62, probably buy the close. A little bit of a surprise. It's a bigger bar, broke out above the last 4 bars, but didn't close above them. On the same bar, it might be a breakout pullback by the close 62. 63, a bad stop order sell, buyers below. Bulls getting a second leg up, one wedge, bull flag. This is 3 legs down, and then second leg. Tight trading range here. Still, bull trend is in effect. We may test the highs, but even if we do, the upside might be limited. Now this might be a final flag. Triangles are often final flags. Range compression. You get lower highs and higher lows. It is a trend that's gone on for 50 bars. So again, this might be the final flag. Maybe one more bull breakout before a reversal back down into a trading range. Triangles have a magnetic pull, so when we break out of them, the market often comes back and tests the apex of them. 67, bull breakout, but again, might be a final flag, so more dangerous to trade this breakout, in my opinion. 3-bar micro channel, second leg up likely, nothing to sell. Micro double top, 70, reasonable stop order sell, but small risk, so low probability. If you're selling below 70, you probably put your stop a measured move up. It's not an ideal sell, but there's an argument for it. Buyers below 70, outside up, and the bulls might get their second leg up here. Bulls want a measured move. 72, low 1, low 2, maybe a low 3, but open gaps, selling pressure fairly weak. May have to go higher to the measured move target before we find sellers. 73, breakout of this range. On the same bar, it might be a breakout pullback, so 73 might be by the close for a scalp for a second leg up. Inside bar, nothing to sell, but very tight trading range now. Too late in the day to be trading, but in theory, if we are trading here, it's still always in long, really minor reversal, nothing to sell. And then a surprise on 77, and look where the market's testing. There's the midpoint of the triangle. The bulls had 1, 2, 3 legs up, truncated wedge, and then the market raised back down to the triangle. So this looks like it was a final flag, last breakout in the direction of the trend, and then reversal back down into a trading range. So strong reversal and follow through, but now we're testing support. Probably buyers down here, but strong enough breakout and follow through for the bears that it'll probably get a second leg down. We're just too late in the day. So I think that's going to do it for this review. I ended up doing a bar by bar today, so today's video is a little bit longer. I'll still mark up the chart and throw it on the end of the video. And that's going to be it. So thanks everybody for watching and listening. and I hope everyone has a great night.